Welcome to Chapter 26, Income and Expenditures. This chapter and this model serves as the underpinnings for the next chapter where we cover aggregate supply and aggregate demand. The aggregate supply and aggregate demand model depends on these concepts, income and expenditures. And this chapter is about the circular flow between income and expenditures. And we already know something about that circular flow because we've talked about it in the past. In other words, what if I spend some money to buy an automobile, for example, it goes into the pockets of the producers as income, and those producers end up using that to buy goods and services, and so basically they spend it, and it turns out to be income to another person, and so on and so forth. And so we need to look at this model and explore it. Like I said, Keynes, John Maynard Keynes was really the guy who drove this model home and developed this model. And here's the situation that he faced in the 1930s. He realized, and people, not just he but other economists, realized that the economy did this over time. The economy over time grew, as you can see, upward trend, but it grew. It had economic booms, recessions throughout, even going back to the 1700s that occurred. And what the funny thing was is that we'd go through these booms and cycles, and people were asking, well, why do we even have these booms and cycles? What causes that? That was a big question mark. It still is to some degree. But what they realized was somehow the economy rebounded all by itself, so over time. And so we'd have an economic boom, the market, the economy would decline significantly, a recession, but somehow it would pull out all by itself, no intervention. They didn't even really recognize or acknowledge that there was such a thing as intervention as we see it today. Today we have fiscal and monetary policy to try to not only fix these troughs, but basically to smooth out the overall economy. The smoother you have it, the less pain there is. Down here, when you have lots of unemployment, and you have a lot of pain, economic pain, and up here, the economy is moving so strong, it's moving above its long-run potential, and it only has to come swinging back. And so why can't we have a nice, smooth economy that grows over time to make everybody better off? And so that's what macroeconomics is about. And so Keynes was really one of the first real macroeconomists out there who understood that there was a business cycle. Things seemed to correct on itself, but when we ran into the Great Depression, the recession was so deep and so long that Keynes thought, wow, we ought to be able, there's got to be a way to try to intervene, policy intervention that goes in and fixes this and puts the economy back into a growth mode. And so that's what Keynes set out to do. But in order to understand how to fix the economy, so to speak, you got to first understand how it works. And so here we have the income and expenditure model that happened. So we're going to get into that model. We're going to shortly get into a multiplier. There's an economic multiplier out there that Keynes recognized and used in developing this theory. The economic multiplier works like this. If I spend a certain amount of money, say I spend $100 today, that money goes into the pockets of another person, like we said before, and then that person turns around and spends a portion of it, and then the next person who gets that money spends a portion of it. And so if I spend $100 today out of my, I just take it out of the drawer and start spending it, it's going to have an economic impact that's far more than $100. That's the multiplier effect. Keynes recognized that, by the way. Give you a little bit of background. In the Great Recession, or the Depression in the 30s, we had a strong stock market. The stock market did really, really well. And in part, the reason for it was it was a stock market bubble that was in part caused by excess credit in the market. In other words, there was margin loan requirements that were very, very low. So you could leverage yourself up with only a few dollars and buy a lot of shares of stock. So you'd only have to put a few pennies down, a few percent down on a stock, and you could buy a shares of stock. And so you could spread your money out a lot. And so basically people were over leveraged, and so the stock market roared. Well, when the stock market bubble popped in October of 1929, what it did was it caused individual investors to go bankrupt. They couldn't pay off, the collateral. I mean, the stock values fell, which was the collateral for their loans with the broker. So the individuals couldn't pay off their loans to the broker, and the broker in turn couldn't pay off the loans that they had gotten from the banks. And so the banks were holding the bag at the end of the day, so to speak. And so the stock market crashed. The ripple effect through the economy was it caused not only brokerage firms to go belly up, but it also caused banks to go belly up. And when that happens in your economy, your lending, your loans dry up, and loans are what are used for by businesses to expand in their investments. So you have GDP equals consumption plus investment plus government expenditures plus net exports. And so what happened was in the Great Recession, there was a significant drop-off in investment. There wasn't any funding for it because the banks were in trouble. But the thing is, this dropped off. Okay, so it dropped off. It's a small component of GDP. At the time, it was only about 11% of GDP. It's like, okay, so it drops off. Okay. But the thing is, it had a strong ripple effect. It went through consumption and dragged down consumption significantly. So we had basically a negative aspect of a multiplier. You stop spending in one area, and it causes a ripple effect of a dry up of expenditures as it goes on. So you can have a multiplier from a positive perspective, where it expands the economy quickly, and a multiplier that's a negative effect that contracts the economy very quickly. So we need to understand how the multiplier works, and we'll get through that. We'll have to have a better understanding how consumption works and develop a model for consumption behavior, C. Then we're going to develop a model for investment, I. And so we're going to look at this expenditure equation, summing these two guys up, and we're going to see how expenditures in GDP, which is production, match up in an equilibrium, and then how we can how the economy responds to various changes in demand or prices and so forth. Right now, we're by the way, we're not going to look closely at the impact of changing prices. That's where the aggregate supply and aggregate demand model comes in the next chapter. So I should back up a second and say that we're really, at this point, we're not going to have price changes, but we're going to have some changes, and we're going to look at the how equilibrium pans out. How does an equilibrium occur, and how does the market and the economy get back into an equilibrium once it's been disrupted? So let's go right into the multiplier. Okay, so to start the multiplier process, we need to look at some assumptions. We need to put some assumptions in to make things simple. So here's the assumptions. The first assumption is producers are willing to sell more at fixed prices. Okay, what that does is allow us to look at the impact of spending. So when somebody spends some money, it has a direct impact on production, and there's no increase in price that kind of offsets some of it, or if there's a drop in spending, a drop in price. So we're going to keep prices fixed so we can actually trace it through to the production better. the impact on production. The second thing is interest rates are given. Okay, so they're basically fixed at any point in time. We will ask later on, what happens to investment if we have a higher interest rate or a lower interest rate. We will do that, but interest rates are at any point in time in the short run are fixed. 3, there is no G, no government expenditures or taxes. Okay, so basically what we have is GDP is made up of consumption plus investment. Now we'll have our hands full with just these two guys in this chapter. So that's really what the chapter is looking at. These are the expenditures. This is the output. And this is the income for this chapter. Chapter 4 is there's no exports and there's no imports. So each are 0. Exports and imports are 0. And so what we're going to do is we're going to look at now what happens when, for example, a business decides to spend $100 on property, plant, equipment. So a business is going to spend on I is going to go up equal to $100. Okay, you can think of it as a construction company. A construction company suddenly decides to go out and start producing spending $100 more, or $100 billion, or million that you'd like. We'll put zeros behind it, but it doesn't matter. And so it's kind of like an exogenous or outside the model change in spending. So there's you can think of it. I had an old professor years ago used to say, look, think about it as a change in a wave of optimism comes over home builders, and they decide to buy and spend $100 million on the production of new houses. Okay, so now we in this process we need to look at income, and we need to look at income, and we need to look at what you can do with that income. We are going to focus in on this chapter on disposable income. And disposable income, it's going to be labeled YD, and it's YD in your text, and then a lot of other text it's YD. And so disposable income is the income that you have at your disposal after the effect of taxes and transfer payments. So taxes you pay, and you might receive transfer payments in the form of some type of welfare check. And that's what disposable income. It's income that consumers have at their disposal to spend on what they want to spend on. And so in this chapter, GDP, by the way, since we forced G, government expenditures, to equal 0, and there's no taxes, then disposable income equals GDP. But what I want to get at here in this area is that we have disposable income, and it's made up of 2 components. If you have disposable income, you can do one of 2 things, and only one of 2 things. You can consume the money the income that you get, or you can save it. And so every dollar that you get in disposable income ends up increasing your consumption or your savings. And so what we want to do is we want to look at, for example, how much, when your disposable income goes up, how much does your consumption go up? And try to measure that. So here we're looking at, you have a change in disposable income equals a change in consumption, plus there's also a change in savings. But let's focus right in here on this guy. By the way, you could have a change in disposable income and it all being a change in consumption if you don't save any more. So every dollar that you get, you tend to spend more. That tends to happen in lower income people. For every dollar that they get, they tend to spend it because they don't have the ability to save. And people in higher income brackets, they get income, they consume only a component of it, a portion of it, and they save the rest. Okay. So now what we want to do is we want to look at how does consumption change for a change in disposable income. And that relationships is basically called the marginal propensity to consume, MPC. Okay? So how does consumption change with a change in disposable income? We can also look at how does savings change with a change in disposable income, and that's the marginal propensity to save. And so you can think of on a percentage basis or on a per dollar basis, you can think of you have the marginal propensity to consume plus the marginal propensity to save has to equal 1. So in other words, if you earn $1 in income, disposable income, you spend, they say, 90 cents of it, then you have to save 10 cents. So it adds up to 1. Okay. So the marginal propensity to save plus the marginal propensity to consume adds up to 1. Typically, the marginal propensity to consume, it's not unusual for it to be, again, depending on the income brackets, it could be 50 to 95, 0.50 to 0.95. We often assume that it's in this text, in this course, we'll assume that, let's assume it's 95. I think the text goes 90. Let's assume that it's going to be 95. So every dollar we get, we spend 95% of it, 95 cents. Okay. So now what we want to do is we want to see what happens when we have a change in disposable income. How there are ripples effect from that expenditure. And we have to keep in mind what the marginal propensity to consume does. That, since this is less than 1, what it means is for every dollar that I spend, every dollar that I earn and I get in disposable income, I only spend 95 cents. Then the next person who gets that 95 cents only spends 95 cents of that, and the next person spends only 95 cents of that. And so the ripple effect. So you're adding these 95 cents increments through the economy. That's what the multiplier effect does. So we're going to look at various rounds. Okay, and again, we'll think of it from the point of view of a boost of $100 in investment spending, say by a construction company or a corporation for whatever reason, spends $100 or 100 million. If you want to add 6 zeros to the numbers, what happens and how does that ripple through the economy? Okay, so let's look at these rounds and how they work. So we're going to look at here rounds, and we're going to look at the dollar impact of the round. Okay, and then we're going to look at the cumulative impact, the rippling effect of an expenditure. So again, we have this consumption, or this a construction company spending $100 million dollars, and so the first round is $100 million, right? That's the initial round. So the initial round is 100 million. The cumulative impact at this point is 100 million. The second round now happens. So they spend 100 million on construction activities, which is the I in the equation, investment. And so when that happens, $100 goes into the pockets of somebody else. Okay, so they spend this money. $100 goes into, and we're going to assume that it goes into the consumer's pockets. So here we have the first part of the expenditure to 100 is the investment, and then what happens is only a fraction of this $100 is going to get spent. And what is that fraction? Well, it's going to be a fraction. It's the MPC times the initial $100 change. And so in this case, it's going to be $95 if we have a marginal propensity to consume of 9.95. That means this round will have $95 of spending, and cumulatively we will have $195 in economic activity. Okay, so now this $95 here is going to go in somebody else's pocket. Oh, and by the way, this is consumption. This component is consumption. I should put the I's and the C's here. Investment, consumption. So this $95 gets spent, okay? But and it's going to go into the pockets of somebody else, but they're only going to spend 95% of it. So it's MPC times the 100, and that's $90.25 of additional consumption. And so we have a total here at this point of, I did the calculation, 285.25 is the total cumulative impact. And then it continues. So then 95% of this number gets spent on the next round. So it's MPC to the third power times the 100 will give me 85.73 in additional consumption. And then we have a cumulative impact of $370.98. And this continues down till it basically gets smaller and smaller till there's nothing left. Now, the question is, what does that boil down to? Well, if you get one of those calculus books that's like 3 inches thick, and you go back about 2 inches deep into that text, you'll find a chapter on infinite series. And that's basically what's happening here. This is an infinite series. It just keeps going and going. You get smaller and smaller as you go. And so mathematicians know how to deal with infinite series, and that's what we want to do. We're not going to be here all day, all next year, forever trying to figure what this number is. We can do it mathematically pretty quickly. Let me show you how to get down to it. So ultimately, what I'm trying to do is relate this $100 change in expenditures to a cumulative impact. Okay? That's my goal. So what is that multiplier effect from here to here? What is that thing, the multiplier component? Well, let me show you here. So here we have, let's call it Y. We have a change in Y. Okay, a change in income is going to equal 1 for 100%. Okay, that's what this is. So for the initial expenditure has a 100% impact on the economy for the initial $100 change. Then the next impact, right, is the MPC. So for you spend $1, 100% impacts the economy. Then only 95%, in this case, the MPC impacts the economy. So for a $1 change, you're going to get 95 cents here, okay? And so that translates into this $95, okay? And then you're going to have, and that's to the first power. Then the next impact is this MPC squared right here. So we just covered this one, the initial one, the MPC, then MPC squared, then NPC to the third power. So it's MPC squared plus MPC to the third power, and it just continues going on. Okay. Now, again, that's an infinite series because it goes on to, that's an infinity sign. You can't really deal with it. So there's a trick. And the trick is, let's take this equation and multiply it by MPC. So I'm going to take this change in income, okay, for basically $1 change, and I'm going to multiply it by MPC. And when I do that, I'm going to get MPC, because 1 times MPC is MPC. Then MPC times MPC to the first power is MPC squared. And so this times MPC is MPC cubed, and so on, all the way to infinity. Okay, so this is to the 1 power, second, third, fourth. Now what I'm going to do is I'm simply going to subtract the two equations. When I subtract the two equations, I get this. I get delta y minus delta y MPC equals 1. Okay? Because notice what happens. So I take this y and I subtract the delta y times MPC. So here's this one. Here's this guy right here. And then what I did, now look, I took this one. This one's coming here. Notice what happens. This one cancels with this cancels with this cancels with this, and it goes all the way down to a point where when you get all the way down towards infinity, each one of these MPCs, since they're less than 1, they're basically 0. So you can ignore them farther out to the right. And so what I did was I just collapsed this entire infinite series, which would go around the Earth forever, because it would come out this way, and then I'd come out on this end of the paper after I went around the Earth. And so we can stop all that nonsense and look at it directly here. So now we can take the delta y and just look at this part. Look how simple it became. So now just collect the terms, collect the delta y's. Okay, and so what we have is we have delta y equals 1 over 1 minus MPC. This 1 over 1 minus MPC, that is the multiplier. That's the cumulative effect of going from this initial $100 expenditure to this total. And so if we plug in the numbers, what it means is, it means this. This is 1 over 1 minus 0.95, which is 20. Basically, we have a multiplier of 20. And so the way we're going to write that out is this way. Okay? We're going to write it out this way. We're going to have the change in y, in income, is going to equal 1 over 1 minus MPC times the change in autonomous expenditures. Okay, so that's autonomous aggregate spending is what it is. And so this multiplier is 20 times the initial change in what we call autonomous or exogenous, outside the model, change of $100. And total is we're going to get $2,000 of economic impact from that $100 initial spending of money. And so, wow, look at that, you know. Now you can see why the government is interested in trying to take the economy out, because if it only spends $100, it can get $2,000 in economic activity. Whew, that's great. It turns out that it's not that. It turns out we're making the assumption that, look, if I spend $100, the next person takes that $100 and spends only 95% of it, and the next person spends 95% of it, and the next person's 95%. It turns out that that doesn't always happen. There are people out there that pocket the money and don't spend it, or spend only a fraction, a much smaller fraction of it. And so the multipliers are not 20, so that's pretty high. This possibly would be a multiplier for money that was spent and given and pocketed amongst people without very much money, poorer people, because they, like I said before, they tend to have a marginal propensity to consume close to $1. So the government likes the idea that, you know, you can really take advantage of the multiplier effect with poorer people. This multiplier effect kind of falls apart with wealthier people, and you really don't want to boost wealthier people anyway. It makes sense that you target this towards the poor. So this concept, by the way, was used back in 2009. The U.S. government enacted an $800 billion stimulus package called the American Recovery and Reinvestment Act. And in that act, it included $48 billion in money for transportation. And so the idea was to target it. Okay, so we can, you know, have construction workers out there on the roads that would build roads and develop roads and bridges and so forth and build our infrastructure, so that because those people probably would have high MPCs. And so when you're in a great recession like we were in 2009, if you targeted the right type of people, you could work this multiplier concept better. And the other thing was it was strategic in a sense that, okay, it was money that was going towards roads and bridges, which is infrastructure, which will improve our labor productivity, our productivity down the road in the future, in the intermediate term, once these things get built. So the idea was, get these what we call shovel-ready projects, projects that are ready to go, because if it takes a long time to implement them, what happens is, you're in an economic recession here and you decide 2009, we're going to spend 48 billion or 800 billion for the whole package right here. But it takes 2 years to implement. By that time, the economy has a tendency to recover all by itself. And then what happens is, by the time that money gets spent, the economy pulled out, and it becomes actually inflationary because you put the economy in an economic boom. So the timing has to be right. So when the U.S. government implemented that $800 billion recovery package, they were trying to find what was called shovel-ready projects that were all already planned, already designed, and just had to be spent. Easier said than done in any case, and it didn't quite work out that way. But that was the idea. And by the way, Japan did the same thing a while back to try to stimulate their economy, again with infrastructure and road spending. Okay, so now that we see the multiplier in effect here, let's better get a better understanding of how consumption works. So consumption, and we're going to look at the consumption function. Okay, so what we're going to look at the consumption. Remember, we're looking at consumption of households, and we're going to have an equation that says consumption, overall consumption, is A plus the MPC times YD, disposable income. And so what this equation says is, look, even if your disposable income is 0, so this part cancels out of the equation, you're still going to have autonomous spending. People still have, even if you don't have any job and you have no disposable income, you still have to live. And so autonomous consumption, that's what the A stands for, autonomous consumption. It's not driven by stuff that's inside the model. It's kind of like an exogenous thing. It's outside the model, but we still have to have it because people need to live, regardless of whether they have income. And not only that, but when you look at this one from a macro perspective, the overall economy, you still have a minimum level of expenditures out there. So what we're looking at here is this equation for a line. And so here we have YD, which is disposable income on this axis. As your income goes up, your consumption for households go up. And the equation for the line is this. The intercept is A, so that when you have 0 disposable income, you still have consumption. And then you have this line with a slope, and the slope is the marginal propensity to consume. So as income goes up, you're going to go up, you're going to go out this way, and you rise by the marginal propensity to consume. So that is the change in consumption for a change in disposable income, which is exactly the way we define MPCs. MPC equals your change in consumption for a change in disposable income. Okay. So now what we want to do is look at, like, what shifts this consumption function. So this is C, the consumption function. What shifts it? Well, there's a couple of shifters. There's two main ones, and the two main ones are changes. The first, I'll write it here, changes in future disposable income. Okay, future. This should be labeled current disposable income to be clear. So what happens is when you have you're living according to this line and your income, disposable income goes up, you consume more. We know that. But this whole line will shift, not movement along, because movement along happens when you change current income. But if you foresee your future income going up, you don't wait till your income actually goes up to start spending. People spend earlier. So if you foresee your future disposable income going up, then your consumption function will increase and move up. And we assume a parallel shift. We assume that your marginal propensity to consume stays the same. So as I said, that wealthier people tend to have different marginal propensities to consume. We're going to assume that marginal propensity to consume stays the same throughout. Okay, that's not true in the real world, but for this model, we're going to assume it. So we have nice, smooth, parallel shifts in the consumption function. So if future disposable income goes up, your consumption function goes up. If you expect your future disposable income to drop, then your whole consumption function will shift down. Okay, so that's one item here. The other one, and this is an important one, is so is the first one, but it's expected or current wealth. Okay, so if your current or expected wealth increases, your consumption is going to go up. So wealth is how much money you may have in the bank, or somehow tied up in assets, so that what happens is, if you feel that you're a wealthier individual, that wealth is going to translate into this stuff is translating into higher autonomous expenditures here. And so that's what's going on. Your current disposable income is unchanged, but your shifters here, your autonomous expenditures are changing, and the effects are coming from disposable income, future disposable income, and current and future wealth. Okay, so if your wealth suddenly drops, then you're going to see a drop in your consumption, parallel drop in your consumption function in that line. Now, we need to look at investment spending. So let's look at investment spending more closely. Okay. The important thing is, and we have to distinguish here, is that you have actual investment by firms, and you have which is composed of unplanned investment, and I'll define that in a second, plus planned investment. So what we're going to do is we're going to break out investment into two components. And this is investment by firms. We had consumption by households a second ago. This is by firms, to keep it simple. And so what we're saying is firms have actual investment expenditures, and part of it is unplanned because they can't predict the future perfectly. And then they have planned expenditures, things that they're anticipating. Okay? It turns out that this unplanned component is inventory. This is inventory. And so, and this component would be property, plant, and equipment, for example. So it would be property, plant, and equipment. It could be inventory that they planned to invest in. But the unplanned component will certainly be inventory. So inventory is key to this, especially unplanned inventory. And here's an example. You can look at, for example, Hershey Chocolate produces, let's say they produce 5 million candy bars in a week, but they end up selling 6 million. So what happens? Their inventory declines by 1 million bars, and translate that into dollars. That's what's called unplanned investment. And so their inventories have declined. Okay, so that's what we mean by unplanned investment. Firms that can't anticipate what happens, their inventory drops off, and it's a buffer. So that's, I mean, really, if you think about it, any store that holds inventory is holding inventory as a buffer for the most part. So stores have stock, they have warehouses, they put a lot of stuff on the shelves. They can't predict how much is going to be sold in any given day, and any given week. And the same thing with supplying raw materials for automobile manufacturers or computer manufacturers. They have lots of raw materials stocked up. It's expensive. It's called working capital. It takes a lot of money to run a warehouse. It's a lot of money tied up. But there's value to inventory, because it buffers that unanticipated changes that go on. And it does more than that. It also allows businesses better manage their production, so they can have a production run of a certain type for a week, switch over to a production run of another type of good for another week, and so on. So it works there, but in this case, we're really looking at inventory as a buffer for unanticipated changes in demand from consumers. Okay. Now let's look at this this planned investment, this planned investment component, which is property, plant, and equipment mainly, and look at what drives that and what can change that. And there's three factors that can change that planned investment. The first one is interest rates. Well, when interest rates go up, your planned investment goes down. Why? Because when the interest rates go up, it means that it costs more money. It's more expensive to borrow, and the opportunity cost of money means that you're tying money up in your investment in property, plant, and equipment that could be used elsewhere. So there's an opportunity cost to buying any property, plant, and equipment, or tying your money up in inventory and working capital. So when interest rates go up, it becomes more expensive, whether you borrow or you don't borrow. If you borrow, obviously, then you're in higher interest rates. You're going to see an increase in your interest expense. But even if you're not borrowing, the fact that you got money tied up, it could be earning money in a bank account somewhere at a higher rate of interest. So interest rates determine a large part your investments. And so when interest rates go up, R goes up. That means your I, investment P, I should put a little P there, plan goes down, and vice versa. Okay, so when this goes down, this will go up. Okay, that's the first factor. The second factor is that we have expected future GDP. Okay, expected future GDP goes up. So if you think that gross domestic product is going to go up, production is going to go up next year, then firms are going to have to prepare themselves for that production. And so they don't actually wait till to try to get that production done. When they anticipate higher expected future GDP, they're going to start planning for investing in it today. So that's the other component. And how much they decide to invest today depends in part on their capacity. So if they have excess capacity, in other words, they have property, plant, and equipment that's not being used, then that's slack in their business. And if they have a lot of slack, then that will retard and reduce any planned investment spending. Even though you may have a higher expected future GDP, okay, that may all else be equal, cause your planned investment to go up. But if you have slack in and excess capacity, then you're not going to see very much of an increase in investment, even if you think future GDP is going to go up. So you have to keep that in mind. And so it's only when firms run into bottlenecks and they have very little slack in their business that you start seeing planned investment increase. So now let's try to summarize what we just covered. So we have in this chapter GDP, gross domestic product, is equal to expenditures now. So this is production is made up of consumption expenditures by households and investment by firms. Okay? And we saw that consumption can be broken out into autonomous consumption independent of disposable income, subsistence consumption, so consumption that you have to have regardless of income, plus a proportion of your disposable income. And so and that's the MPC, and we know what the MPC is, your marginal propensity to consume. Now, in this model, disposable income equals GDP, and that's because we chopped off taxes and we chopped off net exports. So these things have been chopped off So and there's no taxes. So our disposable income equals GDP. And so the other thing you want to keep in mind is that we now have a new concept that just developed a second ago. We have aggregate planned expenditures. Okay, these aggregate expenditures that are planned, and that is composed up of consumption. So what we're saying is that all consumption is planned out. There's no unplanned consumption. In other words, consumers know exactly what they're doing. It's the firms that have a hard time predicting what to do, and so they have unplanned investment. But here we're looking at, in this equation, planned aggregate expenditures is consumption plus the planned component of investment, only the planned component. Okay. So now what we want to do is we want to graph this. You know, we graphed consumption against disposable income. Now what we want to do is we want to graph this equation right here, and then develop a model, you know, an example, some numbers to try to work with this model to see how you know, a lot of it boils down to how the economy returns back to equilibrium, like I was talking about earlier, how it snaps back all by itself. Has to do with this unplanned inventory. So let me show you a graph of this. So we're going to have on the x-axis, we're going to have real GDP, and on the y-axis we're going to have planned expenditure. We're going to have planned expenditures. So aggregate expenditures planned, and we can put the consumption function in first, and the consumption function looks something like this, where here is the autonomous consumption A component, and the slope of this line is your marginal propensity to consume. Okay, that's what we drew before. Okay, except this time we're putting it on real gross domestic product, because now we're going to overlay on top of this planned investment spending, and we're going to assume planned investment spending is fixed. So IP actually IP is this difference right here. I should be careful here. IP is this difference, and this total here, this top line, is your planned aggregate expenditures. It's made up of consumption plus the investment component. Okay. So now keep in mind that when you're looking at this with this consumption line, that you're moving along this consumption line when you have a change in disposable income, because remember, C equals A plus marginal propensity to consume times your disposable income, YD. And so you have people have a habit of wanting to move along this curve, changing GDP, and it's really technically a change in disposable income. Now what we want to do is I want to take this and use an example, a numerical example, combined with a graph to show you how planned aggregate expenditures and real GDP can pull apart, and they pull apart and they're not equal to each other because of the inventory. So we have discrepancies between real GDP equaling total expenditures because of inventory. And so inventory actually buffers the two relationships. So let me show you. Let me give you an example. I'm going to start off slightly different than what the textbook does. The textbook will give you a table and kind of just lay it all out for you. I'm going to show you how to build a table quickly. So here we're going to have consumption. Get this lighting right here. Maybe that's a little better. So here we have a consumption function. Okay, and I'm going to assume that I'm going to assume that autonomous spending is $10. And then I'm going to assume in this example, so this is a new example, that the marginal propensity to consume is 0.90. So every dollar spent, 90 cents is consumed, or every dollar in disposable income 90 cents is consumed. And I'm going to multiply that by YD, and so YD is going to be something that changes on the graph. Okay, and then I'm going to say that IP, I'm just going to make it up, is going to be, say, 30, so it's fixed. And from this, I can build a table that outlines the income expenditure model, basically, and how it works. So what we're going to do is we're going to put here disposable income / GDP. So this is disposable income GDP right here. Here is consumption. Here is planned investment. And consumption plus planned investment equals your planned aggregate expenditures. Okay? And then our difference between what we're producing and what we plan to spend, and what's spent here is going to be IUP, our inventory, unplanned inventory. So let me show you. To start off, let's start off with GDP of 0. We start off with GDP of 0. In other words, disposable income. Remember, in this model, GDP equals disposable income, because there's no government involved. There's no taxes to draw away from your income. So your income that's at your disposal is equal to GDP. So whatever you produce, you make an income, and the government doesn't take any of it. So if your disposable income is 0, plug this in, right? Your consumption is going to be 10. Okay? And so I said that planned investment is 30, so it's fixed at 30. So what we have is a total of 40 in terms of planned aggregate expenditures. Now look at what happened here in this particular line. We're spending $40, 10 on consumption, 30 on investment, but we haven't produced anything. So if we're spending and we haven't produced anything, we have to be drawing down inventory. And so inventory is going to drop. And we're going to call that unplanned inventory because we didn't anticipate it. Otherwise, we would have changed our investment spending, our planned investment spending. Okay. So now I'm going to go and just jump up $200 in disposable income, or GDP in this case. And so plug $200 in disposable income. 200 times 0.9 is 180, plus 10 is 190. Planned investment is still fixed at 30. Total planned aggregate expenditures is 220. And the difference here is, look, we're buying up 220 in expenditures, but we're only producing 200. So that means we still drew down. We're still in this scenario drawing down $20 in inventory, unplanned inventory. Now, if we go 400, we just continue this. We come to a point where, look, what's being produced equals what's being spent. And so our drawdown in our unplanned inventory is 0. When our unplanned inventory is 0, that's signaling to us that there is an equilibrium at that point. There's no tendency to change. And you'll see that in the graph that I'm going to represent, but it's kind of hard to see it in the table here. So hold on for a minute. Let me just put some more numbers here. So here I filled out the rest of the table. And by the way, some of the problems in the book will give you, they won't give you this consumption function. And they'll ask you, from this information, can you figure out what the consumption function is? So not knowing what this equation is up here, can you figure out from this line, from this row here, this column, can you figure out, and in this column, can you figure out what the consumption function is? Well, you can, because remember, the marginal propensity to consume is your change in consumption for a change in disposable income. So you can see your consumption is changing here by 180, right? divided by your change in disposable income of 200, that's telling you that you have a marginal propensity to consume of 90. So they're at 0.90. Okay, so you just figured out that part. Then you realize that when you have zero disposable income and you're consuming, it's like subsistence type consumption, then it's 10. That autonomous consumption is 10. And so there you have it. You have your consumption function by just looking at the table. Okay, so now let's graph this. We want to graph this relationship. And the graph is a little tricky, so we'll spend a little time on it. So I'm going to draw a nice big graph here. And what I'm going to do is I'm going to put the aggregate expenditures on this. Again, the planned aggregate expenditures, it's basically spending. Here we have GDP, real GDP. Okay? And if we graph out this planned expenditures, okay, we're going to get something that looks like this. It's going to start out at 40. Why does it start out at 40? Because when we have zero GDP, planned expenditures are 40. Okay. And so this represents the AEP, planned. And the slope of this will be, I mean, you can figure out the slope, you can look at it, it's going to be the same slope as the marginal propensity to consume, because it has it's parallel. Remember I showed you here, it's parallel to this line. The consumption line is parallel to the AEP line, because inventory that's planned, investment that's planned, is constant. So they have the same slope. So they have the same slope here. The slope is the same as the MPC, is what I'm trying to say. So let me drop some of the numbers into this graph carefully here. So at 200, GDP of 200, we have come over, and this is 220 in aggregate expenditures that are planned. Come out to the 400 mark, and we come over, and this is at the 400 mark also. That's where we have the equilibrium. We go to 600, come over, and at 600 we have planned expenditures of 580, and at 800 come over, and we're at 760. Okay, so that's how we relate these graphically. But what we want to do is we don't have in here a good representation of what the equilibrium looks like, and how when you're out of equilibrium, the economy tends to snap back into an equilibrium. Okay, the old classical model, the stuff that people realized a long time ago as to why the economy all by itself tends to snap back, but it may take a while. And that's Keynes' issue, remember? So here, what we're going to do is, I'm going to get the right color, see if I can get a green pen here. I'm going to put in a 45-degree line here as best I can. I'm going to put a 45-degree line here. And there's my 45-degree line, as best I could draw it. So often in math you put a line like this to signal that that's a 45-degree line. Okay, and so notice the 45-degree line is going right through our equilibrium. This 45-degree line, I'll put 45 here, is the place where your planned aggregate expenditures, or your aggregate expenditures in total, right, equal your GDP. Okay. And so that's here is an equilibrium. So when what you're spending, what you plan to spend on, equals your production, there's no change in inventory, there's no drawdown of inventory, there's no adding of inventory, you have an inventory of zero. So the difference between these two lines, and you can't really see it, one's green, one's blue, is the unplanned inventory. And so go back to the table here that I put together, and if you start at the 200 level, we had unplanned inventory right here of minus 20. So what this is saying is, at this point, our production was 200, people were spending 220. So if they're spending 220, we only produced 200, we had to draw down inventory. The drawdown in inventory is represented by this difference. Okay? And if we're drawing down inventory, we have a disequilibrium in the economy. Production doesn't equal spending. And what that means is the economy, firms are going to have to ramp up their production because their inventory just got drew down by 20. And so when you're to the left of this equilibrium point, your inventory is being drawn down, and that means that firms are going to have to ramp up production. And when you ramp up production, well, look here, P for production, they're going to move in this direction. So when you're to the left of this equilibrium point, inventory is being drawn down, it's negative, it's not anticipated, and firms are going to have to make it up the next period, and they're going to expand and move towards an equilibrium. Now, if you're to the right of this, go to the 600 mark. And at 600 mark, we're producing 600, but we're only spending 580. What that means is it means that inventory has accumulated by 20. Unplanned inventory has accumulated by 20. And the more you produce and the more you move out in this direction, your unplanned inventory increases. Well, what happens is when a firm has unplanned inventory, its inventory is building up, it starts to slow down in its production. And when it slows down its production, it starts moving in this direction. So we end up getting an equilibrium from this relationship built on the idea that firms can't predict their sales. They have inventory to buffer it, and it's that inventory lever that gets the economy back into equilibrium. So now, remember what I said earlier on in the course. Economists are obsessed with equilibriums and disequilibriums, and how the economy and how markets react to disequilibriums. And now you got a sense as to why we're doing this. Remember I told you, look, we've got an economy historically wiggles around, goes up, it goes down through the business cycle. But economists like to imagine that there is a long-run trend. And you can imagine that long-run trend in the economy as the long-run growth, the potential growth of the economy, and its long-run track. So the economy grows over time. It grows because of productivity. It grows due to population. But we look at this as the equilibrium track of the economy. And when the economy goes through booms and busts, those are deviations from equilibrium. So we think of this as an equilibrium, and where the economy would grow nice and smoothly, and there would be no unemployment, for example. When you have these wiggles, you got deviations from equilibrium. And economists, the classical economists especially, and economists a long time ago were very interested in why the economy snapped back into equilibrium. What are the underlying causes? And so Keynes, in this model, came up with an explanation through the inventory process, that unplanned inventory process, as one explanation for how businesses and firms and the economy snaps back into an equilibrium when we're out of equilibrium. Now, what we want to do is we want to tie this concept of an equilibrium and expenditures to the multiplier effect. We haven't done that. And so the way I'm going to do it is part graphically and part mathematically. So here we have aggregate expenditures. Here we have real GDP. And we have I'll put it in a dotted line so it's easy to see. We have our 45-degree line, the dotted line, and we're going to have our planned aggregate expenditures here, line, which is consumption and investment spending, planned investment spending, and we're going to have an equilibrium right here, and we'll call that Y star. Y star right there. And so there's our equilibrium. Now, so we're starting from an equilibrium in this process, and we're going to ask ourselves what happens when there's an increase, let's say, in planned inventory. So let's say inventory 1 year drops off, and you realize your inventory has been drawn down. This is, you increase your inventory, and you plan to increase your inventory the next year. So what happens? Well, if you plan to increase, you have an increase in your inventory, you're going to have your aggregate planned expenditures are going to shoot up by the amount of the change in the inventory, right? So you're going to have this increase here, which is your change in your IP, change in your planned investment from inventory, okay? But notice what happens if you look carefully at the graph. You're going to notice that GDP is going up substantially more than, so this is GDP1, this is GDP2 equilibrium. The change in GDP is going up significantly more than the investment. And that's because there's a multiplier effect going on in the economy. And that multiplier effect is, again, what helps you snap back in the equilibrium. And so the multiplier works like this. The change in Y star equals the multiplier, okay, and times your change in aggregate autonomous expenditures that are planned with a little p there. And so we know what the multiplier is. It's 1 over 1 minus MPC. So we take it, multiply it by the change in autonomous or exogenous aggregate expenditures, this guy right here, times, so what's changing in this example is your planned investments changing. And so what happens is if you have, say, a multiplier of 10 times whatever your change in investment spending, you have, so basically what you're doing is you're magnifying, bring that down so you can see it, you're magnifying this change by a factor of 10. If your multiplier is 10, you know, you'd have to have an MPC of 0.90 to do that. And so just as an exaggerate, nobody has nothing has a multiplier of 10. I'm just showing it as an example. They're usually, like I said earlier, lower than that. But you get the hint, you get the story as to what's going on. There's a multiplier effect. So the point is, you know, you can have downturns can be caused. The cause of a downturn can be quite small because of the multiplier effect. But the point is, you can reverse that if the government was wise. Step in, reverse that, and take advantage of the multiplier process. Get us back in the equilibrium. And another thing we want to keep in mind, and I'm about to transition into the next chapter, chapter 27. And here's the way I would like to transition. This chapter is a short-run discussion and a short-run model of what's happening in the economy. Remember, I told you it was the underpinnings for the aggregate supply and aggregate demand model that comes up in chapter 27. And in the aggregate demand and aggregate supply model, on the axis, the y-axis is prices, because we're going to have to deal with price changes. We are in the short run here because prices are fixed. Remember, we fixed prices, and when we fix prices, you can think of it this way. Go back to the example in the analysis we did way back chapter 3, where we looked at supply and demand for individual goods and services. And so we have individual goods and services. We had supply and demand, and let's say we had a shift in the demand curve. So a demand curve shifts. Okay, you have a shift in demand, and so you go from D1, D to D prime here. And remember, why could that happen? It could be changes in taste and preferences. For some reason, consumers suddenly like this particular good. So demand shifts out. It could be there's more consumers. It could be that their income increased, and so on. And so you have a movement in this shift in this demand curve. And when we did that, a couple of things happened. So keep in mind, here's our equilibrium points where we start out. I'll call it point 1. What happens is we end up in that chapter, in the earlier chapters, for an individual good now here, not the aggregate economy, to this new point 2 here, with a higher price. Okay? And when we have the higher price, we also have an increase in output, Q. Okay? In this chapter, we assumed that prices were fixed. Prices are fixed. And, you know, prices are fixed in the short run. Things are fixed in the short run. Things become very flexible, as we've seen throughout the course, that things are flexible when we're in the long run. Prices change, wages can change in the long run, and so we don't have to deal with that. But when we're in the short run, prices are fixed, and so we're on this point right here. And if you remember, I mean, this is basically a price ceiling. Remember, a ceiling is below the new equilibrium, so and a floor is above. So we basically have think of it as a price ceiling, and we had a price ceiling. We had excess demand by this amount, right? Well, what do you think that is? I mean, in chapter 3, when we did this model, we basically said, oh, we have excess demand, and here's the equilibrium, because this is where we actually transact, and the demand is here. We basically have excess demand. We have a shortage right here. Okay, but you know, now we're much further advanced. We're all the way up into chapter 26, and so now we're bringing inventory into the story, where we didn't have that into the story in chapter 3. And so, what do you think this is? This shortage can be a drawdown in inventory. So you can have your drawdown in inventory, and so you can match your demand there. And so you can look at it from that perspective. And now what we want to do is we want to go a step further. We have inventory underlying the model, but we also have to address increases in price. We also know that we're in the short run, because as I've showed you several times, if you think of the economy over the long run, business cycle, and it's growing, that there's a long run potential path for the economy. And that's what economists, and even the Fed today, has this potential output idea, that this is the potential for the economy growing at a nice stable pace. And that's probably about the best you can do. And if we're good at being a macroeconomist, we can get rid of these deviations. These deviations are deviations from the long run, which by definition means these gaps are short run phenomena. And so when we're away from full this potential equilibrium, we are in the short run. And so in the next chapter, we're going to look at an aggregate supply, aggregate demand curve. We're going to allow for flexible prices. We're going to get there. We're going to actually allow for flexible wages eventually. And we're also going to get into, and as a result, we're going to be in the long run. And so that's where we're going.